Hi, this is MeTime Television covering United States stocks. This video is being broadcast simultaneously through a partnership with MeJune Television. We're holding a special event and we're very grateful that so many of you are applying and joining us. We're currently offering our event in 3 different ways. First, we're offering a 50% lifetime discount, and this is the lowest price you can get if you look at our annual plans. We're only offering this until January 2nd, so if you're interested, please make sure to sign up before then. We've been filming videos for the American Stock Elementary School for about 9 months now, and there are textbooks I use when I teach those lessons. So the PDF files of those textbooks, annual premium members can come in here and download them right away even now, so please download them. I think it would be great if you could watch along with the American Stock Elementary School and use this time to improve your overall knowledge about United States stocks. And we also do an annual live session. It's scheduled for January 3rd at 10 a.m. Korea time. So together with Chief Executive Officer Ji-hoon Mi, we've selected the top 5 promising stocks for 2026, and we'll provide the live link only to our annual members on that day. So we hope you'll show a lot of interest in the event. And since there's not much time left before it closes, we'd appreciate it if you could pay attention and apply as well. Today is Foresh's Smart Investors shopping list, and we'll continue with the rules. Today's featured stock is called Celestica, which is a very hot stock right now. It's been covered a lot on the MeJune channel, and the Chief Executive Officer has also included it in his portfolio. Many clients are interested in it, and not just on the MeJune channel. Anyone interested in United States stocks is paying attention to it. The stock price has risen and it's a popular company, so many of you may know it. Let's review if the company is solid, its growth potential, valuation, and supply and demand. Thank you. Celestica went up by about 7 or 8 compared to the previous day, reaching around $290. Looking at it here, it seems like our AI trading signal sold Celestica too early. It's unfortunate since the sell signal appeared at $94, which is a shame. But if you look at the initial buy signals, they started coming out when it was around $12, from $12 and $24. The discovery happened quickly, so we made a lot of profit, and the cumulative return is now $378. If we had held it up to $292 until now, I think it would have gone over $500, which is really unfortunate. Anyway, you can see this as a trading signal that timed the market really well and discovered an early growth stock right at the beginning. So there were a total of 9 trading signals, and if you look here, you can see losses at first, like 5 and 4, but when the returns are positive, they come out big, like 76 and 68. A loss of -1, a profit of 11, and -3. So, the basic strategy of trading signals is to keep losses short and let profits run for a long time. So, when a trading signal comes out, you should follow it, but if a stop loss occurs, quickly cut your losses short. When it works out well, you can let your profits run for a long time with this kind of strategy. Celestica was also one of the companies that matched very well. I can explain it to you like this. If you look at the recent stock price, it dropped by 22 over the past week. If you look at the stock price over the past 6 months, if you joined at this point, it went up by 98, but if you look at the current daily stock price, you can see that it dropped by 22 in just a week, so that's quite a big drop. You could say this company has fallen much more than the index. Recently, the correction has grown significantly, making it crucial to decide whether to keep holding or, if interested in this stock, at what price to buy. These are key points now. Let's review the diagnostic score. It's currently 69, placing it in the top 12% of 5,500 United States listed companies. At this level, it's a blue chip stock. If it ranks in the top 10%, it's top tier, but even in the top 10 or 12%, it's still an excellent blue chip. You can see that this is a company receiving good evaluations, and if you look at the score it received last year, you can see it's drawn out like this here. It's drawn this way, showing improved growth and profitability, a slight drop in cash generation, and a higher monopoly score. That's the pattern. So overall, it became a better company and it became a bit more balanced. If you look, sometimes a company is drawn with very high growth on one side, making it look sharp, but as it develops, it starts to take on a more perfect pentagon shape. When you're looking for early stage growth stocks, this kind of shape is the best. So, growth is sharp here, financial stability is at least guaranteed, and instead the cash flow is quite good. Later, as the cash flow improves, profitability also aligns, so the company starts to fill out in this way. Currently, Celestica is shifting from an early stage growth stock to a growth company. That's the direction it's heading. Next, let's take a look at how things have changed compared to a year ago by scrolling down to the bottom. It increased from 64 to 69 points, a rise of about 5 points. When I looked at which part increased, a year ago the growth score was 50 and now it's 75, so you can see that the weighted score for growth has become much higher. The business monopoly rate also went from 45 to 55 and financial stability is at 90 points, which is very high. Profitability also increased from 55 to 60 points, so the margin rate has gotten much better. You can see that these margins are gradually improving. Earlier, we saw that cash generation power decreased a bit, dropping from 80 points to 60, but overall it can still be evaluated as having sufficient cash generation capability. So overall, as the company's monopoly score and growth score have recovered, it has become a better company compared to last year. I think it's good to see it this way. Now let's take a look at this company's performance. If you look at the consensus data, the end of December this year has passed, and at that time the sales were 26 and the earnings per share was 81. Usually during times like this, the stock price rises a lot. As you can see here, the sales were 21 and the earnings per share was 77 in 2024, and in 2025 the sales are 26 and the earnings per share is 80. It's unlikely that the stock price of companies whose earnings per share increases by 80 over about 2 years will fall. That's a very high number. So if you want to find companies like this, you need to look for companies with sharp growth potential. And if you want to check this in the data bar, you need to look at the year. So in the case of Celestica, next year there's a 32% sales growth, and the year after that it's also 32%. So in terms of sales growth rate, that's very high. But when you look at the earnings per share, it's 24 next year and 35 the year after, so the earnings per share improvement isn't keeping up with the sales growth. I think this is one of the issues where Celestica needs to improve its profit margin. However, in terms of sales growth rate, this company still shows tremendous growth potential. In this case, its stock price has often moved in tandem with Broadcom's stock price, especially because Broadcom chips are installed in the products that Celestica provides. So the stock price movements of both companies have shown significant trends. Because the products this company manufactures are completed components for data centers, or they provide networking hardware as finished products and services. A lot is invested in expanding, operating, purchasing new products, and renewing AI data centers, isn't it? So when there are talks about an AI boom or collapse or concerns about excessive investment, the stock price does fluctuate a lot. But the question is whether these factors will affect future growth potential. It's very important for you to keep an eye on changes in the data regarding expected performance, as well as changes in how management explains consensus data during earnings announcements. Focusing on these points will be crucial. As you can see here, the stock price rose significantly over the past 2 years, but recently it's been undergoing some corrections. It went up this much, and now it's adjusting by this amount. Compared to April 2023, it's still up by quite a lot. So among the growth stocks I mentioned earlier, if you find companies that continue to grow by 70 or 80% for 2 or 3 years, it's worth holding on to those companies even if they experience some volatility. When stock prices correct, drops can be steep, sometimes about 40% from the peak. If you can't handle that, it's tough to invest in these companies long term. So the trading signals we provide may have sold a bit early, but since we identified them early on, we were able to achieve a high cumulative return. I think referring to these trading signals could be a good strategy for you as well. In the future, things like earnings per share are also growing right now, but then at what point will the stock price be undervalued and have a good valuation? I mentioned before that this in itself is not what I consider valuation. This alone, high or low, doesn't mean it's undervalued or overvalued, so only consider valuation when you can truly assess it. When the left and right values have the same ratio, like 20 to 400, 15 to 300, or 10 to $200, they each equal 20 times. So based on the PR, this is drawn at about 20 times as a standard, and when the stock price is this high, it means the PR has gone above 20 times. So, at around the 20 times level, the stock price has no choice but to be considered very cheap, and we can only expect the stock price to move in this direction with this kind of movement. And the valuation looks good when we look at the valuation chart. So we'll first take a look at the supply and demand side, and then finally look at the valuation. If you look at the short-term signals, it has turned here. The green line has crossed down. So the 5-day moving average is now at $290, and the 21-day moving average is at $308. The current stock price is $292, which is just above the 5-day moving average, but I'm not sure how today's trading will go. But for things to stabilize in the short term, I think it needs to break through $310 and stay there for a while to settle down. Looking at the midterm signals, it hasn't completely turned yet. It took some time for it to turn here, so right now the green line is at $308 and the 61-day moving average is at $293, but the current stock price is $292. It needs to go up above that quickly, get back into the $300 range so that this line doesn't get adjusted and can move on to the next phase. That's how you can look at the current supply and demand situation. So in the short term, the supply and demand trend broke down, but now it's recovering and is right at the point where it's about to break through or not. That's the position we're in right now. So from a supply and demand perspective, I don't think you need to buy in advance just yet. It would be better to wait for something more certain. That's how you should look at it. Now I'll take a look at the valuation. If you look at the valuation, there haven't been many opportunities to buy this company. As you can see here, we're showing our own valuation band chart, and this was the best time. At that time, it was almost at this line, the dotted line shown here, which represents a very high valuation line. So that's why the stock price has continued to rise like this, and if you look ahead, it will keep going up like this. We're calculating using earnings per share for valuation right now, and this bottom line will go like this as the very lowest line, and in the middle, it's following this trend, going up like this kind of trend. Then this point is the cheapest point. So if we calculate in advance what the lowest price will be at this correction point, I think that will be the good price to buy at this time. So first I looked at some of the raw data and did some calculations. After doing the calculations, I found that the current price is $290, but it's around the $240 level. So if it enters around the $240 level, the price will be the one I mentioned earlier. This price, the lowest one I talked about before. It would have been best to buy at this price since it dropped the most. When reflecting next year's fair stock price, the price equivalent to this one is about $240. So since it's $290 now, is it at a fair price? These parts will increase over time anyway. With the earnings per share base rising as noted earlier, it's expected to grow by 30 or 40 next year, so this will also increase by that amount. Based on that standard, the price point we encounter seems to be around $240, right? So at that price range, it's actually a pretty safe entry point. But to reach that price, the supply and demand will probably have to turn down in the short term. That's why the price would come down, so don't rush to buy it right away. Make sure to check if the supply and demand is turning around before you make a move. You can check using the exponential moving average chart since it's free, so that should be enough. If that's not possible for you, it might also be good to refer to the trading signals we provide. Anyway, you should pay attention around the $240 level. If you look at our stock chart on about a 6-month chart, this is roughly where that level would be. At $240, it would be around here. At this level, I think it's entering a price range with some merit. If it holds up well and things line up in that range, I think it could be the best timing. This concludes my review of Celestica. Thank you for watching.